In problem 5-23 on page F189 of the text, we start to look at the issue of cash accounting versus accrual accounting. As you've read in your text, cash accounting tracks spending and income based entirely upon receipt and outgo of cash. This method, while accurate, does a poor job of matching income with related expenses. As a result, the concept of accrual accounting was developed. As we go through this problem, we should be able to see some of the differences between the two methods, and hopefully you will get a grasp of the concept being displayed. By looking at the problem, you will see a list of various financial transactions. Requirement A asks us to prepare a January 2004 multiple-step income statement using the cash basis of accounting. Once again on the screen in front of you is the blank form that I use in completing this kind of a problem. The first transaction tells us that the company paid the January office rent of $2,000 on January 2nd. The office rent goes on the multiple step income statement under operating expenses. So $2,000 goes on the line next to rent expense. The second transaction is purchased $25,000 of material inventory on January 5th. The amount due is payable on February 5th. Since this is not actually going out in cash until February, this does not belong on the cash basis income statement. To keep track of what we're doing, this $25,000 will go on the same line as the costs of goods sold, only instead of putting it into the statement, it goes into the due column. The third transaction is purchased $15,000 of merchandise inventory in January and paid cash. Since this was a cash transaction within the month, it belongs in the income statement. So it goes on the line next to costs of goods sold. The fourth transaction sold merchandise that cost $12,000 for $18,000 to a customer in January and received the cash on that date. Since this is a cash basis statement, the fact that the merchandise cost $12,000 is irrelevant and doesn't belong anywhere on the schedule. But the $18,000 for the sale goes on the sales revenue line. The fifth transaction is sold merchandise that cost $9,000 for $13,500 to a customer. Once again, the $9,000 is irrelevant on the cash basis statement. In addition, since the $13,500 will be paid in February, it goes over in the due column in line with the sales revenue. The last transaction is the office rent for February, which was paid on January 31st. Since this is a cash transaction, even though it is for the month of February, it is recognized in January, so it gets added to the $2,000 to the rent expense line on the statement. Once again in my format, I had already put in the formulas to make the whole thing work, so now you're looking at the complete answer to requirement A. Moving down to requirement B, we're going to do an accrual-based statement based upon the same input data. Again, the format is already put together on your screen, only this time I have labeled the columns accrual and not applicable. The first transaction is for January office rent, and on an accrual statement it doesn't matter when it's paid. What matters is what it's paid for. So since this is a January use of the money, it goes on the statement for January and on the rent expense line in the statement. The second and third transactions, since we're doing an accrual statement, go on the costs of goods sold line under the not applicable column. Once again, it doesn't matter when the cash goes out, but rather what matters is what period the transaction applies to. The sale of merchandise for $18,000 that cost $12,000 generates two number entries on the accrual-based statement. The first entry is putting the $18,000 On the sales revenue line, the second entry is putting the $12,000 on the costs of goods sold line. Once again, it doesn't matter when the payment was made or when the merchandise inventory was purchased. The next sale works exactly the same way. The $13,500 goes on the sales line and will be added to the $18,000, and the $9,000 goes on the costs of goods sold line and will be added to the $12,000. The final transaction, even though it was paid in January, belongs in February in the accrual-based system. On that basis, it goes into the NA column. That completes the accrual-based income statement. Requirement C asks us to explain what caused the difference between the income statement prepared under the cash basis and the one prepared under the accrual basis. I would hope from the discussion that we just went through that you would be able to answer this requirement in a brief but complete manner. I will leave that up to you. Finally, requirement D asks which of the two income statement presentations to you think, 1, provides better information as to cash flow for the month of January. Now, looking at the cash flow in a cash basis statement will usually do a better job. The answer for this one is cash basis. The second question, which one provides better information as to what Franks & Company earned during the month of January? The whole concept of accrual-based accounting is designed to provide accurate recognition of income and expense matched with each other. The answer to this one should be the accrual basis. And 3, which one better reflects Frank's ability to generate future earnings and cash flow? Once again, I would say the accrual basis does a better job for this.